So far this year, the S&P 500 has rallied 25% and raking up more than 60 record highs along the way. This is an impressive return, one which highlights the market's rapid rebound from the crash of March 2020. The major indices quickly rebounded from that crash, past previous highs. The recovery was considered the highest first-year bull market gains since 1945 and outpaced the average of 37.5% for all prior bull markets. As the end of the year approaches, so does the question as to how the stock market will perform in 2022. When analysing major bank forecasts, we get diverging expectations. Morgan Stanley expects to see more of a challenging year ahead with a potential 5% decline from current levels. Morgan Stanley's head of equity strategy stated that underneath the surface, we think there are a number of reasons to suggest that global equities' serene progress over the last 18 months becomes somewhat more volatile going forward as earnings growth slow, bond yields rise, and corporates continue to juggle the challenges of disrupted supply chains and elevated input costs. However, Wilson is one of the biggest market skeptics, as he previously called a 10 to 20% correction in the middle of this year, later admitting that he was surprised at the magnitude and speed of the 2021 rally. Goldman Sachs has a far more optimistic outlook for 2022. Goldman Sachs expects the S&P 500 to rise by 9% by the end of next year. However, they do warn that they expect that the record-setting market rally is expected to slow down. If Goldman Sachs' predictions do become true, we could expect the S&P 500 to hit 5,100 by the end of next year. Despite such optimism, Chief Executive Officer David Solomon said that markets could face a rocky time ahead as the global economy seeks to recover from the health crisis. When I step back and think about my 40-year career, there have been periods of time when greed has far outpaced fear. We are in one of those periods, Solomon said in an interview in Singapore. He further stated that he expects interest rates to move up, and if they do, that will take some excitement out of the market. Chris Harvey, the securities head of equity strategy at Wells Fargo, was a very big bull for the year of 2021. However, he doesn't believe that current bull market run will sustain going into 2022. Harvey believes that the market melt-up will last 3 to 6 months. In the second quarter of next year, he expects a more hawkish Fed, decelerating growth and uncertainty regarding elections, which could bring the market down by 10%. He further suggested that he thinks it will be a sell in May and go away. Now, a big question is, how much impact will the Fed tapering have on the stock market? The Fed has begun tapering. A way to know how the market will react is to look back at previous times where the Fed tapered. The Fed taper tantrum of 2013 was actually followed by strong gains in the stock market. The only pullback was the same decline that we saw in September this year. After the Fed's taper comments in May 2013, the market did pull back 5.8% in the next month. However, by the end of the year, the market was up 17.5%. In the 10-month period in mid-December 2013 to the end of 2014, the S&P 500 rose by 11.5%. When looking at the 60-year history of the S&P 500, an era of tapering may result in a 5 to 6% pullback before moving upwards. However, history suggests that there are more gains to come after a taper, potentially across all sectors in the S&P 500. 60 times since World War II, when stocks have had a correction, the markets has continued to rise the next calendar month and have so by an average of 3.3%. Pullbacks are completely normal in bull market runs, with or without tapering. Banks aren't the only ones concerned about a potential pullback. One key measure in which strategists often predict bubbles is the CAPE ratio, developed by Yale professor Robert Shiller. The measure looks at a firm's inflation-adjusted real earnings per share over a 10-year period to indicate a possible over or undervaluation. Essentially, the measure is to indicate whether the stock's price is too high or not. Presently, the CAPE ratio hovers at around 37, which is the highest level since the 2000 to 2002 dot-com crash. It's also higher now than the 30 it reached before the Black Tuesday crash in 1929, which triggered the Great Depression. However, there are many critiques of such a measure and should not be solely used to determine a potential market crash. Higher valuations of the stock market aren't new. Wall Street investors believe that it's time to get more conservative in the stock market. In a study in which 400 chief investment officers, equity strategists, portfolio managers were asked where they stood regarding the market for the rest of this year and next year, more than 3/4 of respondents said that it's time to be very conservative in the stock market when they were asked what kind of market risk were they willing to accept for themselves and clients. Although holding caution, many investors still believe that the stock market can go higher in the next 12 months. About 50% of respondents said that the S&P 500 will rise more than 5% over the next year. 44% said that it could be fairly flat, and only 5% said that it will decline in the next 12 months. The Big Short Michael Burry, who became world-renowned for his accurate predictions of a housing market collapse in 2008, is wary of a potential correction similar to when the dot-com and housing bubble burst. A couple weeks ago he tweeted, "More speculation than the 1920s, more overvaluation than the 1990s, more geopolitical and economic strife in the 1970s. Likewise, Warren Buffett is signaling worry about the stock market, with the billionaire investor extending his selling streak. Buffett's Berkshire Hathaway was a net seller of equities for the 4th straight quarter. We have not seen this trend since 2008. Berkshire Hathaway ended up selling $2 billion more in stocks than he purchased during that same period. Its cash pile has climbed to a record $149.2 billion. The selling streak indicates that Buffett is struggling to find stocks at bargain prices, as the stock market is extremely overvalued. However, other companies have followed Berkshire Hathaway. Amazon, Google, and American Airlines were among a group of companies which amassed significant holdings during the health crisis. We have big legendary investors raising extreme caution regarding a potential stock market crash. Banks are becoming more and more conservative regarding the stock market's potential next year. One thing is for sure is that the stock market is continuously reaching all-time highs, which suggests that the major indices are overextended and overvalued. As for a big correction, we will just have to wait and see.